Now, noise and volatility are major sources of cost. They are also a source of profit for the type of trading I do. For instance, I seek highly correlated products, and I seek to hedge away the primary modes, okay, of those products and trade just on the noise. Okay, if you can create a stable hedge, okay, then then you are in a place where you can then buy and sell just on noise. Okay, and if you can create zero mean noise, okay, that's range bound. That's a highly mean reverting scenario, and I prefer greatly to live in a space where you're profiting off the noise signal in the market. It's a very important component to any portfolio of strategies, is to be able to take advantage of noise. Another way of profiting from volatility is there are very, very profitable operations of option sellers, vol sellers. Basically, we tend to misprice noise, misprice volatility. And so I've been at shops where the major business model was to sell options to risk-averse counterparties. Important to note, in risk-off markets, in risk-averse markets, you tend to have forced participation, price insensitivity. When people are buying insurance, when people are paying up to reduce their volatility, they're already paying up. And so you tend to have a fair amount of spread crossing in risk-averse markets. And so vol selling takes advantage of the way people misprice that risk-off sentiment, or the urgency with which people experience that risk-off sentiment, or simply the risk-off mandate that people experience. And so they will sell, mispriced options, or rather, they will sell that volatility, and wait. Ideally, it expires out of the money for the buyer. So volatility and noise, often sources of cost, often obscuring, but there are also ways to see them as sources of profit.